All right, be the market expert. Let's jump into this. And let's start off with this article from yesterday from Zillow. It's from Housing Wire, but it's around Zillow. It says Zillow mortgage business is growing, and it goes, lenders beware. And it's kind of interesting. It says Zillow is pairing its successor to Premier Agent with its growing mortgage business. So let's look through this, right? And some interesting things that I think that we should know, right? It says we're talking about the third quarter earnings report, and Zillow, their mortgage revenue increased 63% year over year. Okay, cool. Like, I don't know if that's really anything. I couldn't even begin to tell you what 2022's look like. So to be able to look at these numbers, who knows? But it's at $39 million, which is primarily due to the 80% year over year increase in purchase loan origination volume. Okay, cool. So purchase loan origination volume, that's what we would expect. Like, we expect more business to be purchase loans versus refis, right? Like, most people aren't going to be refining down to a 7%. Hope not, right? Like, if someone's refining down to 7% interest rates, I don't know, they were asleep behind the wheel somewhere. But it's really pointing to their funnel. So this thing called the Zillow funnel. This is where it gets interesting. And so we look at this, and it's talking about Zillow attracted over 233 million unique monthly users. So Zillow has huge traffic, right? Massive, massive traffic to the tune of 233 million unique users. And who knows what that really is? IP addresses, all kinds of different things are going into there. And I think that a lot of these companies are under scrutiny like all of the time for where they get their data. But let's just run with it. So it says, oh, well, analytics company Comscore reported 116. That's what I'm saying. Like, there's huge discrepancy depending on like where you're pulling these numbers. And at the end of the day, this is very true. There's no other platform that has as many users on it other than Zillow. Like, Zillow is leading the way. Like, I don't care. Like, we can talk about Redfin, homes.com, realtor.com. We can talk about your website, my website. It does not matter. Zillow is where most eyes go to. And so that's also interesting. And we can get into this whole discussion around the MLSs these days. And, most people are going to Zillow and insert conversation here. Well, let's talk about the Zillow funnel. So established in 2022, the program essentially combines a suite of tech tools. All right. So they have Zillow Flex, right? Zillow Flex, they're taking 40% of agents' commissions from them in lead aggregates. Showing Time, right? So if you guys weren't aware, Showing Time is owned by Zillow. Now they have Zillow Home Loans. The CRM Follow Up Boss was acquired by Zillow this year, and Real Time Touring. All right, cool. We're talking a lot of different components, a lot of different applets, if you will, are owned by Zillow. So when we're looking at this thing, and let's go down to the lower number right here, we're talking 116 million monthly visitors are going to Zillow. And Zillow has Zillow Flex, where they're selling leads to agents, Showing Time data, which they're getting agents data to see how long homes are sitting on the market, how many showings are happening before a home goes under contract, right? They're pulling all that analytics. They got Zillow Home Loans that they're now putting out there that you can guarantee that your clients are getting email notifications about is it a good time to refi or what applications look like. Plus, it's going to be on the home screen when they are looking to purchase a home when they're going to Zillow. Plus, if you're doing Zillow Flex or anything else, you're probably getting advertised your way. Follow Up Boss. What I find interesting about Follow Up Boss, right? Because they're saying that this is driving lead conversion. Well, they're driving lead conversion, which is kind of interesting. I don't know what they're looking at when they're talking about Follow Up Boss, right? Are they looking up that, you have a CRM and your CRM is your useful tool? And because it's your useful tool, that's where you're kind of going to lead aggregate and to build your relationships? Or why is that being pointed to something that is driving conversion? It's going through and it's talking about Zillow Flex, right? Zillow Flex is very interesting. This program has changed so much over the years, right? Back in the day, right? When you would go and you would maybe partner with Zillow or some other third-party lead aggregator, Realtor.com, Zillow, like something along those lines. Homes has a product, something similar right now. You used to just pay for the zip code, right? So you go in, and depending on what zip code you were like a couple $100s to a couple $1,000s per month, and you were signing a 6 to 12 month extension contract with them. But they're collecting 40% of the agent's commissions, which, if you look at this is very, very interesting. And I say it's interesting because Zillow is a brokerage. That's how they're able to do this. Like, Zillow is a real estate brokerage in all 50 states. How they were able to do this is beyond me. Like, they played the game well, and they were able to open up a brokerage in every state. And since they were able to do this, they're able to collect a referral fee. And they're not really a brokerage, right, in the grand scheme of things. So they're going through, as Zillow has said, that they've also been seeing higher traction conversion rates for agents partnering and working with customers who choose Zillow Home Loans, as we help agents and loan officers together better serve consumers when they're ready to transact. Here's the thing. The only reason why I bring this up is because I think it's interesting that Zillow has entered into another space, which we knew that they would, right? Like, when we're going through and we're talking about everything that's happening in our industry, and we're seeing the compressions of commissions happen, and we're talking about a company like Zillow who has shareholders that they have to answer to, you can only collect so much money per zip code. So they're constantly having to change, they're constantly having to add products, they're constantly having to do different things to bring in more money for their shareholders, because they are a publicly traded company. So we'll just watch as this thing kind of goes through. It is getting a little bit different out there. I think what's going to be really interesting to see, again, what happens with Clear Cooperation, national MLSs. There's a lot of different things. Like, Clear Cooperation disappears, and you're just putting it on your company's internal website, which we would have the ability to do. So if anyone doesn't know what Clear Cooperation is, this is what has been like the talk of the town, if you will, except for if you were at the NAR conference. What I understand about the NAR conference this last week is they didn't actually talk about Clear Cooperation. Yeah, Clear Cooperation just means this, right? Like, you're going through, you get a listing, before you can market the listing to really anybody and invite people into the house, it actually has to be on the MLS. And there's a lot of people out there right now, a lot of big brokerages like Compass, for example. Compass is one of these people. They're all for getting rid of Clear Cooperation, which at the end of the day, we're the largest brokerage in the world. And so I don't think it impacts us very much. Like, if it doesn't impact us negatively, at least, I think that it would have some positive to it. And who it would hurt would actually be these smaller brokerages, like these boutique brokerages would actually get, I'm not going to say destroyed. Like, I think that they would find a way to adapt, but yet if they don't have a bunch of listings and they're unable to actually get their marketing out there, their pond gets really, really small. So what happens if Clear Cooperation disappears is real estate brokerages would no longer, not all of them, but a lot of them wouldn't put their homes on the MLS. So then it's no longer on the MLS. And they would keep it internally. They would push it around to their agents. They would figure out some kind of marketing, and they could do whatever they want to do with their seller's permission, of course. And what that gets interesting is then I think that you have the ability to either syndicate out or not syndicate out. So your property no longer goes on the MLS. And we know if it goes on the MLS, it goes to the IDX and it pushes, and it goes, through Zillow, Realtor.com, Redfin. It goes through all these third-party lead aggregators that's pushing the IDX feed out. Well, I would have to believe that we would have an option to say, no, don't push this information out. We're going to do all of our own marketing. We're going to host open houses. We're going to do some different things. And I don't know what that does to a company like Zillow at that point. So we'll keep watching this thing, and it could get a little interesting. I did see this article, and I think this is, top of mind as we're kind of going through, and especially everything that's happening on the East Coast, right? Florida, the Carolinas, what we've seen in Colorado, right? Wyoming, Montana, all these different areas where there's a lot of like natural disasters that are happening. And it's going through and saying 3-year change in median annual home insurance premiums by county. Well, if we look at this thing, it's going through and saying, like, what's going on? What's infecting the home insurances? And first one, it says natural disasters, the frequency and the severity of it, right? Saying losses up to 53% this decade compared to previous 10 years. That's wild, right? When we're thinking about just the amount of natural disasters that we're having, how ferocious they're actually coming through, right? The severity of them. We're thinking about all the water damage and what has happened on the East Coast, the fires that we have in Colorado. This is going to have an impact. And so, with all this stuff happening, we will continue to see home insurance rise. And why that matters to us is that it absolutely affects affordability. And if you're a homeowner, it's going to affect your insurance. So, you're going to care. And as we're going through, it's going to put more compression on the buyer's purchase power, right? When we're going through and we have high home prices, we have high interest rates, insurance is going up, right? Like we have all these different things. This is going to dwarf purchasability for our home buyers. And right, we looked at this last week, and I think it was like first-time home buyers, their average age right now is like 39 years old, right? So we're even putting like a bigger gap in between like first-time home buyership. We're almost talking like you're not going to own a home until you're in your 40s. And I did see some interesting information. We'll go over it tomorrow at Team Rally, just about like some of the demographics of different buyers. We'll kind of jump into that. But risk concentration, number of housing units up 30%. Okay, cool. So there's more units. Construction cost, they've increased since the pandemic. We see this. Remember, like when the cost of lumber, we used to see all those memes on Facebook where they were like, just saw $1 million driving down the road and it was like a truck bed full of lumber, right? Like we've seen this, and we do import a lot of these materials, and so they're coming across. There's big high prices on them. It's having to get through the channels and everything, and so this is going up. State regulations, right, where they're going through it, says well-intended regulations have caused market retreat in high-risk areas, and you totally get that. State lender of last concentration, public homeowners interest reached a new high in 2023, just over $1.3 trillion. Well, let's jump into it. So like, let's look at this thing, and here it is, this more interactive map. Here's Colorado. Let's look. Jeffco is this thing right here. Here's Jefferson County. Let's see if it stays off. Perfect. So we're just talking about Jefferson County. From 2020 to 2023, it's gone up 38%. And so if we were just to look from the median price, right, from 2020 to 2023, went from $2,200 to $3,000 in a 3-year time period, right? That's gone up 38%, almost 40%. Like this will absolutely have impacts on affordability as this keeps going up. And as things are happening on the outer states, right? And they're coming into us. Yes, we have our own issues in Colorado. We do have fires. It's a very, very big deal. And yet all these other things that are happening that we actually don't think that like we really feel, we will feel it, because they're going to have to recoup their money. And things will start to happen where there's going to be insurance carriers that are going to say, you know what, we're out. We've paid out too much money. We are going to have to, either declare bankruptcy or not service this area anymore, which means not that it's going to be a monopoly, but there's going to be less people, less companies that are servicing the area. And that means rates are going to go up. Let's look at Denver. So is Jeffco. Denver is like a little thing somewhere right there. There's Denver. So here we are looking at Denver, 38% again, and went from $2,100 to $3,000, right? If we were to look at Douglas, here's Douglas. Douglas went from 26 to 36, right? So there's another 38%. So if we're looking at this thing, we kind of jump around and look at just even like the bigger was like, if we look at Pitkin County, right? 64%. We can look at some of Grand County, went up 80%. And so when we start playing up in like the mountains in some of these different areas, we're going to see like a little bit higher prices. Let's find Boulder. So Boulder should be somewhere. Here's Jeffco, Boulder, Clear Creek. Why am I missing Boulder? There we go. Boulder. So Boulder's going 44%, right? We're at 2,200 to 3,200. almost 50 or 44.9%, almost 45% is what Boulder has gone up. And remember, this isn't 2024 data. We don't have anything for what 2025, right? Because everything that we do is rear view facing data. So we're going to get into 2025 and we're going to see what insurance is going to look like. And we're actually going to have a better understanding, but let's just be prepared. These numbers are going to go up. They absolutely will. All right.
Charles?
Yes. Yes.
It's Karen. Just a quick question. Is this something we all have access to, like what you just flunked
Yeah.
in, popped around?
Yeah, absolutely. So this is Resi Club. And so you can just type in Resi Club and you'll be able to get it. And then I think it's like their second free article that's available right here on the left. And so I just clicked in it, and then there's an interactive map. When you like it says click here to view the interactive map, and you'll be able to jump into it. Absolutely. And yeah, this Zillow one, I think this one is available. This one should be free as well. And then the next one I'm going to show you is going to be free. So yeah, most of this is free. And a lot of it's going to come from Housing Wire.
Perfect. Thanks.
You're welcome. All right, cool. Let's look at this thing. So let's talk about Logan Motoshami, right? So this is rear view facing data again. This is last Friday. And this is the lead analyst for Housing Wire. So we're going through, and he's talking about housing inventory drops noticeably on election week. And if you guys haven't been paying attention at home, the election was 7 days ago at this point. And so active inventory and new listings are both down. And it's interesting because we could say, okay, is it elections week? Is it interest rates and what they're doing? Is it seasonality? Who knows? Like, we're in such a weird time right now that I think that we could draw like we were to get like that kill chart, right? Where like we're going through and you're putting the yarn together and you're saying like you're connecting the clues. Like, I think we could probably do that for anything that we wanted to right now. And yet, let's look into it. It says the seasonal housing inventory peaks and bottoms have happened later than usual the last few years. And that's what's very interesting, right? Like, as we think about this thing, and back in the day, we had seasonality, right? We would go to sleep as jack-o'-lanterns, we wake up as Easter bunnies, and we just get back at it. And yet 2020 started to break some things because interest rates got super low. And then what happened was 2022 hit. Interest rates skyrocketed. And it wasn't that they went up high. I mean, they did compared to what we were looking at, but just how quickly they went up in a short amount of time. That's what was shocking to everybody. So 2022 rolls around, interest rates are higher. And we're thinking, we're like, oh my God, what's going on? Like, the winter rolls around and like businesses slow down hugely. And it's like, oh my God, we got like some seasonality again. And we started experiencing seasonality back, and then 2023 rolls around, higher interest rates, we got seasonality. 2024 rolls around, and I think we're seeing some seasonality right now. Like, we're seeing it. Most of the time, this is when business starts to slow down. Yet, here's what also we have. We also have people that have been on the sideline for 3 years, right? They've been hanging out. They've been waiting to go buy a house. They've been waiting for either interest rates to go down. They've been waiting for prices to go down. They've been waiting for more inventory to hit the market. Whatever they've been looking for, and they've been realizing that bat signal that they put in the air, that the media has been pushing, whether it's CNN or Fox or YouTube or Twitter or insert whatever here, it's not going to happen. Interest rates aren't going to drop back down to 2%. We're not going to see a housing crash in home prices. We're not going to see an influx of inventory hit the market. And so they're like, I need to get a house. And so we're going to see that. So even though we're seeing some seasonality, we're absolutely going to see people continue to buy and sell even in these months because they're fatigued. They've been hanging out. They've been getting told to wait, to wait, to wait. And they're realizing that help isn't around the corner. And so they have to move now. And so last week we saw the noticeable decline in both active inventory and new listings, which isn't abnormal because, again, seasonality, but we might have had an election variable here. And so we won't know. It says in the past 2 years, starting mid-November, mortgage rates have fallen, and we haven't seen positive forward-looking housing demand data. And then will this be the case again? So let's look at it. So we're looking from the 1st to the 8th. And we went from 735,000 homes down to 721,000 homes nationwide. Now, if we were to look at this time last year, we went from 566,800 to 566,900. So we did see an increase of what, 60 homes in 2023. But yet we did see a bigger decline. Okay, cool. This year. So all-time inventory bottom was in 2022 was 240,000 homes. We're not there. The peak for 2024, 739. All right. So we're a little bit lower than the peak that we saw this year. But if we were to look at this thing, we can kind of see this is where everything starts to drop down. Like you can see for the most part, every year that we're looking, except for 2023, did something a little bit different. But pretty much everywhere else, this is where it starts to teeter off. So I'm not sure it has really anything to do with the election. And yet I think a lot of this has to do with seasonality. So we're going through, but again, we got 27% more homes right now than we did last year, which is huge. We're looking at new listings data. So new listings data, we have 48,863 new homes hitting the market. Here's your visualization of that. It's a little low, right? When we're talking about November, it's a little low where we've been in 2023 and 2022. So, okay, so that did decrease a little bit. So, okay, so maybe something weird did happen. We do see it typically teeter off, but maybe this went a little bit bigger than we've historically seen in the last 2 years. Price cut percentage, we're sitting at 38%. We know historically speaking, nationwide, we see 1/3 of all homes take a price decrease. And we're sitting a little bit higher than that, yet here we are. Here's 2023, 2022. We know it was weird. Super high interest rates skyrocketed. People put their home on the market. Interest rates went gangbusters. They went monstrous. And they were like, well, I really got to sell my house. That's the only reason why I put it on the market. And so we saw more price decreases, right? Yet it's starting to go a little bit lower. We're below 2023. We're below 2022. Not hugely, but 43%, 39%. We're sitting at 38.8%, which is a little bit lower. Mortgage application data, we can kind of see this. We're a little bit higher than 2023. We're not as high as 2022. So it looks like people are still interested in purchasing houses, yet this hasn't helped us, right? Higher mortgage rates always impact the purchase application data. And of course it does. We deal in the highest ticket item that most Americans purchase in real estate. And guess what? We live in Colorado. It's expensive here. I plan on showing this at Team Rally tomorrow, yet the top 10, I think it's the top 10. The top 10 cities in the United States for the most expensive median price point, Boulder's number 10 out of the entire United States at like, I think it's like $840,000 is the median price point. We're not too far off in a lot of these other areas that we live in. And I think it was San Francisco, the median price point was $1.8 million. So huge jump from number 1 to number 10, yet we live in an area where our price point is very, very high. And so when we're talking about high interest rates at a high price point, and the interest rates only matter because that's the cost of money, right? How much does it cost to go borrow money? We know, and we've been seeing a lot of data that right now, at least, most Americans are putting 20%. I would say a bigger impact, not like, I'm not talking like 80%. I'm just talking like 23% are putting a 20% down payment right now. Others are fluctuating a little bit around, but like a 5% spread kind of. And so when we're looking at this, they're borrowing 80% of their funds, if not more, at a 7% interest rate. That means the cost of money is really, really high. And that's why we're seeing this impacted so hugely right now. So going through, here's our prints, right? We're seeing both positive and negative prints as we're going through, and we're looking at this thing, pending sales data. This is promising, right? Like we're looking at this thing. We're actually seeing more people come out of hibernation. Yes, it's dipping off seasonality, but we did cross over 2023 data and 2022 data, right? Like as we look at this, 2023 is over here, this dark red, here's 2022. We've crossed over both of these. So interest rates are still remaining elevated. And this is what I'm talking about right here. yes, interest rates are definitely playing a huge impact on affordability and people's psyche of going to go buy a house. Yet there are still people that need to buy. There's still people that need to sell. They've been sitting on the sidelines, and we have some of the biggest equity that we've ever seen in homes, right? Like we were looking at a balance sheet on a home right now. They're positive. They are in the black hugely. Yes, if you bought in 2022, 2023, 2024, there's probably not a lot of equity in the home, especially 2024, right? But if we're looking at these other people that have bought in the 2000s, they have monstrous equity in their home. And so when we're looking at this thing, if they have to sell, they're still making very good money, on their investment. And we're also seeing people that are first-time home buyers that this is the interest rate that they know, right? Like this is where they're at. And I saw another article where it was going through and it's saying that, where most people coming with their down payment is from saving. They're actually saving. So when we're going through, we're having the conversation, especially this time of year, we're getting back into relationship with people and we're talking to them. And guys, it's not weird if you ask them what their housing goals are over the next 5-10 years, right? Figure out what that looks like. Like you are their real estate economist of choice. And yes, we would love today's business 100%. Like no one on this call, if you were to get a phone call today and someone were to say, hey, will you come list my house? I'm pretty sure everyone on this call would go find a way to go over to that house and go have that conversation at the dining room table and go list a home. And if that's not you, please feel free to put in the chat like, Charles, I got better things to do than go to a listing appointment. I'd be very interested to see that. Yet, what are we doing to put out in the pipeline to go figure out what someone's goals are in the next 5 years, 10 years? Maybe it's an investment property, right? Maybe they're going through and they're looking to see, if they're going to actually go buy a duplex, right? So they can go house hack a little bit. Maybe it's a triplex, maybe it's a quadruplex. Maybe they are going to go buy their first house in 5 years. Maybe they do have a spending plan, right? Like they are saving and they're going through and they're like, you know what? At this rate, we've been putting X amount of dollars away and we know that we're going to be able to have 20% down. We talked to a lender. The lender said we needed to fix our credit. So we're on this credit fix plan, right? It could be any of those things. Figuring out, hey, what is your real estate goals in the next 3 years, 5 years, 10 years? And then figure out a way that we can help them stay in contact with them because this is what we know, right? When we're going through life events is what makes most people buy and sell houses. 2021 was a little bit different, right? Like people were just moving for the sake of moving. Like it really happened. People were moving across the street because they wanted a different view. Very real. Yet most of the time, people are moving because of life event, marriage, babies, divorce, death, deployment, right? Like something is happening in their world is helping them buy or sell, like it's actually forcing them a little bit. And what we know is that these life events are going to happen. What we don't know is when. So we just need to go through, make sure that we're having as many conversations as possible and be an emotional proximity to these people when they're looking to transact business and they're thinking of us. So we're going through, we're not going to talk about the 10-year treasury bills
Hey,
or
Charles,
the mortgage spreads. Yes.
Karen again. I have probably a rookie question now. Where is it? You said something about print positives or negatives. It's up a little higher. I wrote it
Yeah.
up. What does that mean? Negative.
Yeah, great question. Not a rookie question. When we're looking at this, we're talking about purchase application data. So what they're doing is they're looking at purchase application data and they are basing it off of, is it higher or lower than where it was in previous years? And so, right, it's going through and it's saying, like, let's take the second one. When mortgage rates started falling in mid-June, here's what the purchase application looked like. So in June, we had 12 positive prints where more people were going, they were calling their lender and figuring out what they qualified for. This is what this is. They're going through and it's saying that we had 5 negative prints. So less people were actually calling their lenders. There was a flat print and then 3 straight positive year-over-year growth prints. So what this is this is your consumer, whether you partnered them with your lender or they're just calling your lender, because it's a pretty astronomical percentage of people that actually go to a lender first before they actually contact a real estate agent. And what they're doing is they're reaching out and they're saying, hey, I want to know what I qualify for. That's what this is.
Got it. Thank you.
You're welcome. We're not gonna talk about mortgage spreads, but here's what it is. So this is this week, right? Because this is Friday, this is review facing data, and this is his crystal ball that we're looking for. So it's the inflation week again. It says we will also have retail sales, and a few Fed presidents will be giving us their take on the economy. And so it'll be interesting. I don't know if any Fed presidents, I know that Powell got on the other day, and I think the biggest question that at least was circulating around Twitter was that he was asked if he was going to step down when Trump took office, and he said no. And then the second follow-up question was, can you be forced out? And he also said no. So that's going to be very interesting because they're definitely going to butt heads with this going, because obviously the president is not the Fed president's boss. And it's going to be weird. It's definitely going to be weird what's going to go forward. So we're going to see what this looks like. I think that if we were to look, we're probably going to see retail sales still go up, especially the time of year that we're in. And when we're going through and we're looking at this thing, this will obviously have a negative impact on our economy, because we have to keep in mind that the reason why interest rates go up is because it's the Fed's way to encourage us to stop spending, right? That's what they're doing. They are restricting the flow of money by raising rates. And so they're raising rates because they don't want us spending money, because we are weakening the dollar, right? And so this is what this looks like in our world. I want you guys to go back into 2021, whether you're a real estate agent or not. What we all know, right, and what all your consumers know, is homes were lasting over the weekend. They were going over $100,000 over asking, and they were waiving contingencies, right? Like that's the message. Like we all know that, even if you weren't a real estate agent, like that is your conceived notion of what the market used to look like. Well, what made a home that was $500,000 sell for $600,000 cash? Really just scarcity, right? Like there was supply and demand. And so what happened though is we were weakening the dollar, because while we all believe that home should have been worth $500,000, it was selling for $600,000. There was no data. If there was data that was supporting $600,000, that's what we would have listed it for. But we weren't. We were listing it for 500 because that's what, based off of all the comparables, that's what the home was worth. But people were spending an extra $100,000 on this home, which in fact weakens the dollar. When we're going through and we're just spending all this money, like with the cars and everything, right? Cars got super expensive, and we're just spending this money. Credit card debt, right? Credit card debt is ridiculous. And so we're seeing all this stuff where people are not slowing down their spending habits, except for in our industry, because again, we deal with one of the highest ticket prices in the United States. So as we're going through and we're talking, let's talk about Colorado with a $600,000, $700,000, $800,000 price tag, and the cost of money, because you can't put that on a credit card unless you have your Amex Black card, right? That it slows a lot of people down. And so that's the point. That's why they're raising rates, and we are dramatically influenced or impacted more than any other product just because of our price point. So let's look at interest rates, right? Because that's where we're at right now. So this is just 1 year. I have it set for 1 year. This is Optimal Blue. You guys all have access to this as well. I actually like Optimal Blue, at least for a snapshot to the day before, right? Because this is only going to, well, it actually says the 8th. If I were to go to just today, I could show you guys. Here's today real quick. Let's do that. So today, conforming loan 695, FHA 654. So that's what your interest rates look like today. Let's look at this. And so 1 year time, we're kind of sitting like almost in the middle of like where everything has been. We're definitely not in the lows. The lows were, September. And we're sitting up here a little bit higher, but we're still not at the tops, right? Like it could always be worse at the end of the day. There's 753 for conforming. Here we went to 7.2. We're sitting at 6.7 for a conforming loan. But let's look at this. Let's look over 1 month. So here's 1 month. We can see it kind of going down. So there's 6.7 and 6.3. But if we were to look at where I had it, so 6.9, and 6.5. So it really has gone up again. And what's interesting, right? Because we did see the Fed go through and they cut rates, another 25 basis points. But here's the thing, and this is why I give Mitch so much grief, is that it's really not him, but it is the banks. The banks are going through and the cost of lending, the cost of money is going down. Like the Fed is saying, hey, we're going to lower the cost of money to the banks. And the banks get to dictate from there what they want to loan money out for. And a lot of the times it's not in their best interest to cut rates down. And here's the thing, we're all like, yeah, no doubt, because right, they make money on giving money, so they keep the rates up. But here's the thing, purchase application data is down, right? We're actually seeing less people go out and go purchase houses. What they're really trying to stop, though, is people refinancing their houses. That's actually what they're really trying to stop, because what happens is your banker goes through and they lend you money to go purchase a house, right? We mortgage a house, we go get money from the bank, we go buy a house. Like that's what the process looks like. Well, what happens is the bank loans you money. And if you go and refinance, and I think it's like 6 weeks, or not 6 weeks, I'm sorry, 6 payments, I think is the magical number, 6 payments. The bank actually doesn't really make any money off of you unless they get 6 payments from you at your current interest rate. So it's not in the bank's best interest to lower rates, because if they lower rates with all the Fed cuts that we've seen, then the banks would actually lose money. And that's not what they're looking to see. What we're also going through and what we're also talking about is, if we were to look at this thing, there was a lot of concern around the red sweep. And so that's why we also saw a lot of these numbers get baked in, was because when they were going through and they were talking about mortgage rates, they were worried for Elizabeth. They were worried for a presidential, a Senate, and a House sweep, because historically speaking, when we've seen the Republican Party inside owning the House, the Senate, and the presidency, we've seen the economy traditionally do better. And so that's why, and they see more spending, the economy does better, we see more spending, we weaken the dollar. Like that's what happens. More people feel good about the economy, they keep spending money, and then the dollar gets weakened. So that's also why we saw a lot of these numbers get baked in, while we saw the 50 basis point drop, the 25 basis point drop, and we kept seeing rates go up. That's also one of the indicators of why, is because we're worried. The Fed is worried. The banks are worried that we're going to actually see more people go out and spend more money, which is going to weaken the dollar. So let's look at Arvada, right? We've talked about national data. We've talked about interest rates. I just told you that Boulder is like number 10, leading at $850,000 is their median price point. And then here we go in Arvada, $750,000. We're talking about $100,000 price difference, but you have to figure that we're at least in like the top 20, 25 for most expensive cities in the United States to live in. And so that's kind of flatlined a little bit. We see it's gone down a little bit, but it's pretty, let's call it flat. If we were looking at price per square foot, we've kind of gone up a little bit to 325. Average days on market is going up. This is what's interesting, right? And so we talk about days on market, and we use these indicators, especially in here. Like this is probably what I'm printing off to go take to a listing appointment. And I really want to be able to use at least these two numbers, this median days on market and average days on market, to have a conversation with my consumer, right? Because average days on market, we're taking all the numbers, we're taking the lowest price point home, we're taking the highest price point home, we're adding all of them up, and we're dividing them by the total, and that's what gives us the average. So this has all the outliers in it, right? To where we're going through, we're taking all the data, and we're saying we're going to land on 77 days. Well, median, they're just going through and they're going right to the middle number, right? They're taking all the numbers, they're bringing them all in, and they're landing in the middle of all the numbers, and that's 49. So what I'm doing, and I'm having the conversation with my consumer, with my seller, because this is the conversation that we'd be looking at, is if we price the home wrong, we could be sitting on the market for about 77 days, right? So we're talking 2+ months, 2+ months on market versus about a month and a half is the median. So if we were to price the home right, and again, we're looking at all the comparables, we're not looking at what your neighbors did in 2021, right? Great for them. And what we need to do is we need to figure out the motivations. Hey, Mr. and Mrs. Seller, what's important about selling the house? Like, why did you call me today? Where do you need to go? What's your time frame for being there? And then we can actually show like, okay, so if you have to hold on to your home for an additional month and a half, what does that do? And then when we know that historically, like in Arvada right now, that we're seeing 63% of all homes take a price cut. If we were to price your home wrong, not only is it going to sit on the market longer, almost a month longer, we're also probably going to have to plan for a price decrease because 63% of all overpriced homes in Arvada take a price decrease and they're sitting on the market too long. And so we can use these information, have conversations with our consumer to help them match their motivations with their expectations, right, of what the market is going to do for their home. 2% price increase. This number doesn't excite me. Again, this is phase 1, phase 2, phase 3 of new listings, of new builds hitting the market, right, where they're in their second phase, they're in their third phase, they're doing all these different things. Relisted houses. Here's what's interesting. This is going down. And so I almost think that as we're looking at this, we're going to have to watch it to see what this trend really looks like. Yet we're seeing more houses probably stay under contract because of just everything that else is going on, that they've actually made the determination. The home was priced the way that it was supposed to price. Sellers are probably giving up more concessions to get their home sold at this point. So we're seeing a little bit less, but we're still seeing 5% get relisted. And then your median rent is going down to $2,750 a month. So we're still in a seller's market. I think that's one of the things that we have to keep in mind. We're still in a seller's market because of inventory. There's not enough inventory on the market still to justify a buyer's market. And so when we're going through, guys, I think it's just very important. Yes, the Zillow thing's interesting. Yes, we have to know that insurance is going up, and it's been going up, and it's probably going to go up again in 2025 because of the fires that we've had in Colorado, as well as the other things that have happened across the nation. Interest rates have gone up, and they've gone up for a magnitude of reasons, yet they're still a little bit lower than the all-time high of this year. And there's a lot of smart people that believe like 5.5 is a reality, but not until Q3, Q4. And when stuff like that happens, we also know the price points go up. So cost of money comes down, price points go up. So does it make sense if the home is right for your needs to pay a little bit extra per month if you can afford it, if it makes sense for what you're looking for in a home, so that when the market does open back up, you're still paying less for the house that you're interested in today, because that home, historically speaking, goes 4% every year is what we see in the rise of home values year over year.